Now, I know I've said it's real important that we keep these funds entirely separate because people want to know where their tax money's going and grant givers want to know where their grant money's going and it's being used correctly. However, on occasion, you do transfer between the funds. You have to keep track of it. It's important to track it properly, but it does happen. It's easy to imagine. City Hall probably uses some water, right? And so maybe they have to transfer some funds to the water department, which is a proprietary fund, and this is City Hall is in the general fund, something like that. Typically, the general fund will send money for debt services to other funds. Sometimes just a mistake gets made. You took it from the wrong fund. Happens. All right. So anyway, we're going to learn how to do these interfund transactions, and sometimes they're for services, so it's almost like an external transaction. Sometimes they're reimbursements, sometimes they're transfers. All right. So sometimes we use this word quasi-external transactions, quasi-external transactions. So it's just kind of like the water company sold water to City Hall. The electric company sold electricity to the water company, right? It's like governmental entities use services just like anybody else, and the government provides some of those services. So how do you do that, right? You might have reimbursements, right? So you have these quasi-external, you'll have these reimbursements. A reason you could transfer between funds would be one fund paid something for another fund. And again, because of how government works, it's real easy to think, okay, so we're doing capital improvements on a building. It involves some work on the street, which involves some work to the water lines and some work with the electricity. So you can imagine that maybe one civil engineering firm did a bunch of consulting to do that project. And so maybe the water department paid for it all, but they expect to get reimbursed from electric and building improvement funders, right? So, right, and a reimbursement. So it could be an error. Somebody paid for something that they weren't supposed to, and it gets reimbursed. All right. So let's assume the government receives a bill for engineering services for $10,000, and the general fund records it like this: expenditures, account payable, right? So the general fund has set that up, and presumably they'll pay for it with cash, right? It'll become account payable cash at some point. But $2,000 of that was for electricity. Electricity should have paid, so it should have been like an $8,000 bill to general fund and a $2,000 bill to electricity. Okay, well that's not that big deal. So electricity owes general fund $2,000 basically. So due from electricity, $2,000, expenditures, $2,000. So we didn't really have that expenditure, right? It wasn't ours. So we debit kind of like a receivable, but because it's from one of our other funds, we just call it due from electricity and expenditure. So that expenditure went down to $8,000. And then expenditures $2,000 due to general fund goes up, is the transaction at the electric fund, right? So general fund takes that expenditure out and recognizes the receivable, and electric fund puts down that they now have an expenditure and they have that payable, and we just call it due from the other fund. It's pretty simple, pretty straightforward. A transfer is when there's no expectation to be repaid. So a reimbursement is just a straight up transfer. So transfers to a fund are considered other financing sources. Transfers out are considered other finance uses, right? And recurring transfers we typically just built into the budget. All right. Special items is something big that happens. So you might see a special item occurring in the fund, say like you sell a fire truck, right? Well, that would be probably in a different fund. So let's say something that's in the general fund. Sell furniture from the city hall. You buy some new furniture and so you sell the old. All right. Proceeds of capital assets are designated as special items. So when you sell it, you get, of course, when you sell something, you receive cash, and you just put down special item, proceeds, sale of capital assets. Now we talked about this a little bit in chapter 3, that we close accounts. And just like with financial accounting, we're going to leave the assets and liabilities open, right? And we close things to the fund balance. So remember we talked about fund balance being somewhat similar to retained earnings, right? So out in the world, when you're working for a company, you close revenues and expenses to income summary sometimes, and then income summary to retained earnings, and you close dividends to retained earnings. And now that's how everything moves over to the balance sheet. And so all the revenues are zeroed out, all the expenses are zeroed out, and you start fresh the next year. Okay, well, you have to do that for cities, states, schools, any kind of governmental entity. So you close the budgetary accounts, and you close the revenues, and I will come back and talk about that closing process next.